If you've heard the term underwriting before, in a real estate context, this just refers to making projections about the performance of a real estate acquisition or development opportunity, and then using that information to assess the risk associated with an investment and to value a commercial real estate deal. And while we have a lot of content on this channel that goes into the weeds of some of the individual aspects of real estate underwriting, in this video, I want to take a step back and cover the entire process of analyzing a deal from start to finish at a much higher level. So whether you're underwriting deals to build your own real estate portfolio or you're targeting analyst jobs and you want to know what you'd be doing on a day-to-day basis, in this video we'll break down commercial real estate underwriting using a simple 7-step framework, and we'll also talk through the resources that you'll need to lean on at each step of the process. So first and foremost, as a general prerequisite to underwriting any real estate deal, you're going to need a model to work in that can calculate projected cash flows based on a set of assumptions. For the purposes of this video, we're going to be looking at a pro forma that we build within one of our Break Into CRE courses, but as long as you have a model that can translate your assumptions into projected cash flows over time, you're ready to get started with analyzing a deal. And to start building out your model, step number 1 in this process is a simple data input exercise, and this is adding basic descriptive details about the property that you're analyzing. This includes adding things to your model like the year the property was built, the address of the property, the total acreage of the site, the leasable square footage that can be rented by tenants, and any other core information that you're going to want to track as you're analyzing a deal. This part of the process is primarily intended to make sure that you understand the physical characteristics of a property and you're not just blindly crunching numbers without any context around the property itself. And once you have your property details in the pro forma, the next step in this process is adding leasing information into your model, starting with the in-place lease information for current tenants at the property. For in-place lease information, this is going to include adding things like the square footage of each suite, the start date and the end date of each lease, the rent escalation schedule for each individual tenant, and any expense reimbursement structures that currently exist at the property. All of this information is going to be clearly spelled out either within a current rent roll or directly within the leases themselves, so this isn't necessarily hard to find, but this can be time consuming to make sure you get this right. Now, once you have this information added to your model, you're ready to move on to step 3 of this process, which is adding re-leasing assumptions once those in-place leases expire. And the first and one of the most important parts of this step is assigning a renewal probability to each tenant's lease, or how likely you think it is that each tenant is going to renew at the end of their lease term, and this is ultimately going to be used to create a weighted average in your model that's going to drive your cash flows based on 2 sets of assumptions. The first set of assumptions will be for a renewal scenario where the existing tenant signs a lease extension to continue their term past their initial expiration date, and the other set of assumptions will be for a new lease scenario where the in-place tenant vacates and an unknown user will backfill the space. And for both scenarios, you'll need to add assumptions on things like the expected lease term, any sort of free rent period you expect to offer, the current rental rates in the market and where you believe these will go in the future, and even what expense reimbursements are expected to be on each new lease going forward. This is also where you'll add assumptions about capital costs related to releasing a commercial suite, including tenant improvement allowances, any assumed TI allowance growth in the market over time, and any sort of commissions you expect to owe to a leasing agent on the deal. This information can be some of the toughest to pin down throughout the entire underwriting process and relies heavily on using market data, including sites like CoStar for market rents and projections, leasing broker relationships to get a real-time pulse on the market, and even looking at comparable listings on sites like LoopNet and Crexi to understand rental rates in the area and the concessions being offered to new tenants signing leases. Now, once your in-place lease and releasing information is added to your model, step number 4 in this process is finishing out your net operating income calculations by adding your expense assumptions going forward that you're expecting to incur during your hold. This process includes adding information on things like projected ongoing repair and maintenance costs, insurance premiums, property taxes, property management fees, and any other ordinary operating expenses you're planning to incur as the new owner of the property. Historical financials from the seller can be great starting points to use for these assumptions, but some operating expense line items are going to require a little bit more research, including insurance premiums, which usually require going directly to a broker or your existing insurance carrier, property management fees, which usually require going directly to a property management company, and property tax assessments, which require direct research with a state, county, or city to know both when and how a property will be reassessed. Now, once you have your operating expenses dialed in, your capital expense assumptions are next, with step number 5 in this process being to add construction cost assumptions on the deal you're analyzing. These are generally going to be relatively simple in an initial property underwriting, but these should include the amounts of each line item, the projected timing of each cost, and usually a contingency percentage on top of these projections. And again, in most cases here, you'll also need to rely on a third party to come up with this information to add to your model in the first place, usually in the form of working with a general contractor or another construction professional that you know and trust to get the most accurate figures possible based on your renovation plans. Now, once you've added your construction figures into the pro forma, we're starting to get into the home stretch of your underwriting, and step number 6 in this process is to add debt assumptions into your model if you plan to finance your deal with a commercial real estate loan. This is where you'll need to add things like your total assumed loan proceeds, any fees associated with the loan, the amortization period, and the interest rate that are going to be used to calculate monthly payments, and any sort of interest-only period before the amortization begins. Again, in most cases, you'll need to contact a third party to get the most accurate information to add to your model here, but most mortgage brokers and lenders can give you a rough idea of these figures before actually putting together a concrete term sheet, so you can get a sense for what your loan terms are likely to be without having to go through a more formal application process. Now, finally, once you have all of this information within your pro forma, step number 7 to put everything together is adding your sale assumptions to your model to finalize your cash flows and analyze the deal. This part of the process involves adding a projected sale date, any assumed costs of sale related to brokerage commissions, transfer taxes, or any other closing fees, and also selecting an assumed exit cap rate in your model that you believe the next buyer of the property is going to assign to the deal. This is honestly one of the most difficult parts of commercial real estate underwriting, since an exit cap rate assumption can have such big impacts on your projected sale price and ultimately your overall returns. So I'll link another video in the description that goes into more detail on this process, but ultimately, to finish up your model, you'll need to have conviction around a sale price and the costs that are going to be associated with that sale. And then finally, once you have your sale assumptions in place, you now have everything that you need to calculate project level cash flows and come up with a valuation or an offer price on the deal. Most commercial real estate investors use a target IRR, equity multiple, cash on cash, or a mixture of all 3 of these things to come up with a valuation of a commercial property, and these targets are going to be based on the unique goals and objectives of each individual investor and also the risk profile of the deal itself. If all assumptions have been added correctly up to this point, this is just a simple process of adjusting the purchase price in your model to find an amount that, based on your assumptions, would generate the returns that you're looking for. And once you find that number, your model is complete. Now, obviously, we can go into a lot more detail on each of these individual steps, but when I was first starting out in the industry, I really just wanted to understand the overall picture before digging into the weeds. So I hope this is helpful to get a sense of what you might be doing when underwriting commercial properties and what you might be responsible for when working as a commercial real estate analyst. And if you do want to dig deeper into the details from here and you want to learn more about the real estate underwriting process, or you want access to pre-built pro forma templates like the one you saw in this video, as always, make sure to check out our all-in-one membership training platform, Breaking the CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You'll get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, and you'll also get access to the Breaking the CRE Analyst Certification exam, which covers topics like real estate pro forma and development modeling, commercial real estate lease modeling, equity waterfall modeling, and many other real estate financial analysis concepts that will help you prove to employers that you have what it takes to tackle the responsibility responsibilities of an analyst or associate at a top real estate firm. And if you like this video and want to see more in-depth content on any of these steps we mentioned in a future video on the channel, make sure to hit the like button and let me know. And let me know in the comments which part of the underwriting process you tend to struggle with most and why that's the case. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.